Over a decade after it was enacted into law, the Real Estate Investment Trust has finally taken off, with pertinent regulations signed on January 20, 2020. REIT listings are essential to the development of the Philippine capital market and has numerous benefits to its stakeholders.
This will open up attractive investment opportunities and broaden access to the capital market. This will allow big players in the real estate business to raise more capital to further invest in our country, a win-win situation for all.
The PSE had its first REIT listing in August 2020.
I wish to congratulate REIT Inc. for being the first company to offer and list REITs. To be 2 times oversubscribed during these difficult times is a testament not only to the attractiveness and quality of this product, but also to the trust and confidence of investors in the sterling reputation of its sponsor, Ayala Land Inc. Peer companies in the property sector will surely be monitoring the performance of a REIT, including its compliance with the rules and regulations unique to REITs. I am sure that a REIT will prove to be an outstanding model for REIT companies. I am also optimistic that the warm reception to a REIT's offering will encourage and pave the way for other property firms to list REITs in the PSE.
Be part in the development of the capital market and contribute to the growth of our economy through REIT listing. Know more about REITs by joining the REIT Smart webinar on November 17. For more information, you may email us at marketingservices@pse.com.ph.
Good afternoon and welcome to the last installment of the REIT Smart webinar series for issuers entitled The Path Forward for the Philippine REIT Market. I am Pauline Vilvestre from the Marketing Services Department of the Philippine Stock Exchange and your host for today's event. The REIT Smart webinar series is a 2-part learning session designed to equip potential REIT issuers with a better understanding of the intricacies of the real estate investment trust. We hope that through this webinar series, your company consider REIT listing a strategic option in your plans to accelerate post-pandemic recovery and expansion initiatives. This afternoon session promises to give potential issuers a more in-depth view on the outlook and prospects for REITs post-COVID-19 and a glimpse of what the future holds from the Philippine REIT sector undergoing its early stages of development. We are very fortunate to have with us distinguished executives from JP Morgan, Leechiu, and the Philippine Stock Exchange to share with us their insights and experience in real estate investment trust. Also, we will again highlight the PSE Listing Assistance Program developed to assist IPO and REIT listing applicants to fast-track their company's growth through listing. To begin our webinar proper, I will now turn you over to PSE President Ramon Monzon for his opening remarks.
Hi, good afternoon, everyone. Welcome to the second Real Estate Investment Trust or REIT Smart webinar series. We had our first one exactly 1 week ago, and I was quite surprised and delighted at the big turnout of participants. Naturally, I didn't expect to see so many attendees anymore in this afternoon session, but I was wrong. We still have almost as many attendees this afternoon as we did last week, which only goes to prove that there is really very strong interest in the Philippine Stock Exchange's new asset class, the REIT. More than a decade ago, the Philippine legislature enacted Republic Act 9856, otherwise known as the Real Estate Investment Trust Act of 2009. Unfortunately, the implementing rules and regulations formulated by the Securities and Exchange Commission and the income tax regulation issued by the BIR governing REITs were so unrealistic and onerous that it made the law practically inoperative. Accordingly, no REIT was ever introduced or launched for the next 10 years. Fast forward, or should I say slow forward, to January 2020. In a joint signing ceremony participated in by SEC Chairman Emil Aquino, BIR Commissioner Cesar Dulay, and the undersigned, Secretary of Finance Carlos G. Dominguez III, known for his advocacy for a strong capital market, spearheaded the launching of the amendments to the regulations governing REITs, thereby giving fresh impetus to REITs as a new investment vehicle. We at the exchange had high hopes then that we would see at least 3 REIT listings for this year. Then, the COVID-19 pandemic came, wreaking havoc on the global economy, including ours. Yet, even in the midst of this pandemic, we were fortunate to have had the first REIT listing last August 13, and by the country's premier property developer at that. This milestone event proved that pandemic or not, investors will support companies they find value in. I understand there is a good mix of listed companies joining us in this webinar, both directly involved in the property sector and those engaged in other businesses. I suppose most of you want to know, is it really viable to list REITs at this time? As the saying goes, in the midst of every crisis lies great opportunity. Opportunities in REIT do not merely lie in office buildings, malls, hotels, and other hospitality developments. This pandemic reshaped how the world lives. Given what we call the new normal, there has been increasing demand for data centers, storage facilities, hospitals, residential properties outside city centers, among others. The now and the future of REITs will always be viable if you have a good combination of properties in your portfolio. The market capitalization of REITs in Singapore Exchange is a staggering $65.6 billion US dollars. In the Stock Exchange of Thailand, the market value of REITs is $6.86 billion. And for Bursa Malaysia, $5.96 billion. Meanwhile, our one and only REIT so far has a market cap of $0.54 billion. It is clear that there is this big potential for the growth in REITs in the Philippine market. Our team prepared an interesting lineup of discussions and invited notable resource persons who can explain very well what you need to know about REITs. On behalf of the PSE, I wish to thank Mr. Alphonse Halim, Managing Director and Head of East Asia Real Estate Investment Banking of JP Morgan, and our good friend, Mr. David Leechiu, CEO of Leechiu Property Consultants, Inc., for agreeing to share their expertise and experience with you this afternoon. I hope that the 2-part REIT Smart webinar have enriched your knowledge and appreciation for REITs. I encourage you to contact our marketing services team in case you have questions and queries about REIT listing. Again, thank you for your participation in this webinar, and I wish you all a productive afternoon.
Thank you, Mr. Monzon. Before we move to the next part, I would like to inform our attendees that you can type in your questions in the Q&A box at the bottom part of your Zoom app. We will try to answer as many of them during our open forum segment after the presentations. Our next speaker will impart with us perspectives on the REIT sector potential in the Philippines. But before I introduce him, let's all watch this short video presentation.
Our insights, your success.
David Leechiu is the Chief Executive Officer of Leechiu Property Consultants, Inc. David has 25 years of experience in real estate and is considered the leading commercial real estate broker in the Philippines. He has arranged the lease of more than 1 million square meters of office space and sold more than $2 billion in real estate. Allow me to welcome and turn over the screen to Mr. David Leechiu.
Thank you very much, everyone, and Michelle, for that kind introduction. Mr. Munzon, thank you very much for having me over to present our views of what's going on in the market. In summary, I think we are very optimistic about the potential of the REIT market in the Philippines, and only because so many things are happening from a fiscal perspective, demand perspective, and the scale of each of these REITable sectors that I think that this will be a very long, sustainable boom in the REIT sector in the Philippines. I thought I'd just walk you through some of the last 20 years of the Philippines. You know, I guess the biggest obstacle that many investors have about the Philippines is how sustainable is it, or are we the same country that loves to shoot its own foot many times over? I remember back in the 90s and early 2000s that the Philippines is like the millipede that shots every foot. And because we have the habit of doing self-inflicted damage. And I'm happy to say that over 20 years, every economic metric that you impose on the Philippines has been up. Every year, inching forward, upwards, towards the path of prosperity, despite all the bad news that we see here. And so if you look at remittances, BPO employment, tourism arrivals, per capita income, the PSE index, cement consumption, all those things are up for the last 20 years, despite all the bad news, despite all the reasons that gave foreigners not to travel or invest in the Philippines. And these last 20 years has been a brick building foundation of the economy to lead us to the next 20 to 30 years. And I think just as what many financial institutions like the World Bank, like JP Morgan, like HSBC, Citi, all these big banks are all saying that the Philippine economy is in the top 20 fastest growing economies in the next 30 years. And this fundamentally is why, which leads us to what Secretary Sani Dominguez has said many times, that this COVID crisis has hit us at a time when the Philippine economy is in its best shape ever. Had this thing hit us 10 years ago, 5 years ago, we would be very, very, very damaged. And yet today, because of the resilience and fiscal policy, the COVID crisis did not impact us as much or ravage us as much as it should have as compared to other economies. And so we have to thank Secretary Dominguez and his entire team for all the reforms done. Tax reform one was the most difficult one because it was very, very, very you had to be very brave, and you had to have the voting bloc to be able to enforce tax reform the way they did, that benefited tens, if not tens of millions of Filipinos working. And there's a lot of liquidity being generated without additional borrowings and without additional foreign direct investments. And that's just moving capital from undeployable capital into deployed capital just by sheer reform. And I'm most excited about two things. All these reforms has allowed the Philippines very recently to borrow 10-year money and 25-year money at 2.2 and 2.4%. So not only are they record low rates, but also the spreads between 10 and 25-year money are paper thin. And the immediate consequence of that, as soon as we get out of this global COVID crisis, is the collapsing of interest rates to the point where I think a mortgage market will emerge in the Philippines. For the first time, the average home loan borrower will be able to borrow 10-year money, 15-year money, 20-year money at viable rates. Because as you know, today, most people who want to borrow money can only fix rates at 5-year terms at a viable rate. They can fix 10-year loans at 9 to 11%, which is not viable over a 10-year period. You can borrow loan terms at 15 to 20 years, but you can only fix the interest rates up to 10 years. And I think that's going to change. I think there will be a time when people can borrow 10-year fix at 7 or 6%. And that is not a far future. That is going to be a near future event. And the biggest beneficiary to that event will be the property sector, predominantly the home owners. And as you know, there's a 6 to 8 to 10 million housing backlog in the lowest of lowest classes. And you've got a significant chunk of housing requirements in the middle class that need to be served, that cannot be served because of these prohibitive interest rates. But the collapse in interest rates will just fuel the need for stable, recurring income assets that can be held in the most efficient manner. And thank goodness for the REIT sector, because the REIT sector has allowed investors, big and small, to own real estate in the most efficient manner. And so I think a lot of the global funding that is swishing around in the world because of all this QE that all governments are doing is going to look for a home, and the Philippines will be one of those places to park money. And I think the REIT started it all, but I think there are many more in the pipeline, very exciting listings that will be coming around the corner as soon as this global COVID crisis is over. And in the last few weeks, you see it in the market that every company that releases positive news about the vaccine or a cure has a tremendous and exponential impact on global stock markets. And I think that's just going to continue. And so I would encourage all the developers here to continue to build big listings in the REIT sector. Another thing to be very encouraged about is that the Philippines remains to be one of the strongest office markets in the world. We took down 300,000 square meters of new leases in the last 9 months, most of that done in the last 6 months. At the height of the global COVID crisis, at the heart of lockdowns that the Philippines encountered, tenants continued to sign leases. And we service 9 of the 11 largest tenants in the Philippines. The smallest of these tenants employ 28,000 people in the Philippines. The largest occupy 90,000 people in the Philippines alone. And of these 9, only 2 have shed space. And the amount of space they've shed is in the region of 500 seats. It's a rounding number. It's not even 1% of their portfolio. And 5 of these 9 are already expanding in the tune of 2,000 to 4,000 seats. And the other 2 are about ready to expand as well next year. And that's just the 9 of the many clients that we service. And more often than not, I am meeting clients that are saying, you know what, our onshore ratio to offshore ratio is 90% onshore, 10% offshore. And they want to reverse that to bring it closer to, in the immediate term, 50-50, with a view of bringing it to a 70-30 ratio in favor of offshoring. And the beauty about the Philippine office market is that even as the world goes into recession, more jobs are being created in the Philippines. We said this at the very early start of this COVID crisis, within the first 4 weeks of the global COVID crisis. And I'm happy to say that the leasing numbers have validated that statement. We think tourism is coming back in a big way. 92% of tourism in the Philippines is local, but that is going to change. What many people forget to realize is that we have built 7 new airports, all in the Visayas, in the last 5 years. Most of that in the last 3 years. And we've got a big one coming up just around the corner in Clark. Clark plus these 7 new airports in the Visayas are going to work hand in hand to make tourism, global foreign tourism in the Philippines, grow in an exponential basis to the point where, in my view, in my personal view, tourism will be larger than any industry the Philippines has within 10 years. We are so lucky to have Secretary Romulo run the tourism department, and I am very hopeful that somebody as competent and as energetic will take over her within the next administration. And so there are many, many signs of why tourism in the Philippines will continue to grow and be more attractive. I love the platform about the Turquoise Triangle, which is the geography, the sea, the group of islands between Boracay, Cebu, Bohol, and Palawan. Because this little pocket of geography of ocean and islands and limestone are some of the most beautiful landscapes in the world. And certainly the top 3 diving spots in the world. So many YouTubers, IG users are promoting bird watching, surfing, diving, free diving, sailing, yachting of all kinds across all levels. That's helping the Philippine tourism market grow. And all we're waiting for is this exit out of this COVID crisis. And I think the residential market on the lower, middle end, below have been decimated quite aggressively and ravaged by the COVID crisis. Thankfully, the government has stepped in to protect many in this market from both distressed tenants and foreclosures from banks. So much so that I think because of those efforts, this market will hold. It's being ravaged, but it will not collapse. And it will make a strong recovery as soon as employment numbers come up. But what is more interesting is that the upper middle and up, so the upper middle, the upper class, the high end, and the luxury markets are all either holding or growing. There's a small geography in Batangas Bay called Punta Fuego, Kawayan, Tali, and Terrazas. And those properties are anywhere between $300,000 transactions at the smallest to $3 million transactions at the largest. And those are all second home resort beach property. And those prices are up 50 to 100% since February. And the transaction volumes I have not seen since 20 years. So the high-end market, that demonstrates the amount of liquidity that's currently present in the system in the high-end market with zero borrowing. And yes, going back to fiscal management, the Philippines has gone to 39% debt to GDP ratios to 53% GDP to debt ratios today. But even at 53%, it still is one of the least debted countries in the world. And all of that is going to be distributed through the grassroots. All that debt that we've incurred in the last 5 months through this ravaging COVID crisis is going to go straight into the grassroots, either directly or indirectly through the corruption system. And as you know, the Philippines do have a corruption problem, if you don't know that. And that will be complemented by election spending, which will happen in the next 10 months. And these two combinations will allow us to increase the liquidity in the market, to allow us to recover from this COVID crisis much faster than many people think. And that's coupled by the collapsing interest rates that will fuel real estate. What is so exciting about that is this third factor, which is infrastructure. The Philippines in the next 12 months is about to receive the single largest injection of infrastructure it has ever seen in its entire history. This map shows you 12 projects, 145 kilometers total linear infrastructure between roads, bridges, and rails that will be completed in the next 12 months. And this map shows you as much as 45 million people, representing 60% of the GDP of the economy. And the immediate impact of all this infrastructure is that I think it will cut traffic by half. It will cut traffic by half. And so the average worker who is commuting 6 hours a day, every day from home to work and back, and yes, it is possible in the third world of the Philippines to spend a whole working day stuck in the car traveling. or in the bus, or in the tricycle, or in the jeep, or in the rail, traveling from home to work and back. And that's going to be cut by half. And I just hope that we have enough common sense to be able to deploy that additional time that we've got back from the car and deploy it into things that are self-nurturing, nurturing our loved ones, educating ourselves, educating others, and translate to economic activity. To give you more detail about what's going on in the property office market, 300,000 square meters of new transactions, 70% in Metro Manila, 30% in the provinces. The largest component of any 1 year involving the provinces is this year, 2020. And 50% of the demand is coming from the BPO sector. And I think the BPO sector will keep growing. I'm so excited because in addition to the 300,000 square meters of done transactions, there's another 330 to 400,000 square meters of transactions that want to get transacted within the next 4 months, from today all the way to February, despite all the uncertainty you see in the COVID crisis, in whether it's work from home, et cetera, et cetera, et cetera. Another thing to take heart is the fact that despite the campaign of work from home, despite the campaign of hub and spoke models, most tenants are still paying their rent. Most tenants, big and small, have renewed most of their leases for 5 years onwards. We have just transacted 2 of the biggest tech companies in the world with a total footprint of 200,000 square meters in the Philippines. And all these leases have been renewed 5 to 7 years from today, from 2019, 2020, 2021. And that's a testament of what kind of long-term plans they have for Philippines. And unfortunately, the POGO sector is being ravaged right now because of the new tax policies that the government's imposing on the POGO sector. I wish we had not done that. I wish we just let them be and allow them to grow in the Philippines, because that growth will translate to additional investments faster than anything we have seen in the Philippines, job generated directly and indirectly faster than any industry we have seen. And for as long as they continue to invest in the Philippines, it will just make it better recovery situation for the country. And I think somewhere along the line, the government will backtrack on its position in the POGO sector, because many government officials from all sorts of levels, whether national or local, are feeling the gap between the loss of POGO versus the time when they were all expanding. Now, I'm not blind to the amount of office space that has contracted in the Philippines. In the last 7-8 months, as much as 240,000 square meters of leases have contracted. But 60% of all those contractions come from the POGO sector. It's not because of work from home. It's not because of companies closing because they're having a hard time. They're closing because of the POGO sector and because of the tax treatments. The BPO sector has contracted somewhat. A few companies have contracted, but that is less than 1% of the total BPO footprint in the Philippines. The POGO sector has let go of 10% of their footprint in the Philippines, and I think they will shed another 5% in the next 6 weeks. I think if we do not backtrack on the taxes, they will shed another 15% next year, 2021. If we're able to backtrack, I think the POGO sector will continue its aggressive expansion plans in the Philippines in 2021. And I hope that happens. And while you might think that 300,000 square meters of new leases and 240,000 of contractions is a big thing, and that you can match that against 2019 and say these demand numbers are down by 70% compared to 2019, you can feel bad about that. I feel really good about that, because you still have 300,000 square meters of new leases, especially when you consider that the largest economy in the world, the United States of America, have shed 4 million square meters of office space, most of that in the last 4 months, with another 1 to 1.5 million square meters about to be shed in the next 6 weeks into the year. So You want to feel good about 300,000 because I really feel good about 300,000 square meters right now. And I think we'll have a big bounce back in 2021 because we see it in the pipeline of transactions. I'm a big believer of tourism. As I said, I think it will be larger than any industry we have. It will be larger than remittances, larger than the BPO sector within 10 years from today. And that is because the market is so unpenetrated. There is a big global tourism market out there, and the Philippines is just carving out something like 50% of 1% of that market. The sky is the limit. Yes, the glass is 99% empty. It is 1% full, and there's only one way to go, and that's up. And so this slide shows you how small the market is for Philippines. The height of the foreign tourist traffic in the Philippines was 8 million visitors last year, and while that is our historical high, it is nothing compared to other countries. This slide shows you local native populations in blue, foreign residents in light blue, and foreign tourist traffic in each of these countries in red. It shows you that the Philippines is so long way to go. But it's a very easy, low-lying fruit for Philippines. And why am I excited about this? Because this will play significantly in the REIT market. Developers will be able to develop new, big, scalable, multiple-site hotel portfolios all throughout the Philippines. And they will use the REIT market as a way to raise cheap capital, scalable capital. And they will not just do that in the Philippines, but they will also start doing that across other countries. Which leads me to the REIT market and why I see it flourishing for the next, for many years, for decades to come. Number one, only 1% of global assets are REITed. And that is going to change because of the collapsing interest rates, looking for steady yields throughout the world. And the upgrades, the credit rating upgrades that the Philippines enjoyed even through the global COVID crisis. The Japan's ratings agency upgraded us to A from triple B plus a few months ago. Throughout the COVID crisis, we were probably one of the few, if not the only country in the world that enjoyed a credit rating upgrade during these times. And those credit rating upgrades will just attract more foreign capital that could not enter the market in the Philippines, that will enter the market very soon. And black shows you the Singapore REIT index, which is the Michael Jordan, Tiger Woods of the REIT global sector. Everyone looks up to Singapore to be the idol of REITs. And if you can look at that, you compare the black line versus the Singapore Straits Times index. And you can see that had you invested REITs over the last 10 years, I'm not just talking about the last 10 quarters or 10 months or 10 weeks, but the last 10 years, you can see that the REIT index is some of the best decisions you could have done anywhere in the world. And I'm hoping, yes, the Philippines is very far from Singapore in terms of performance, integrity, but I'm hoping that we can mimic some of this into the Philippine REITs. What is interesting about the Philippines is that while we don't have the value numbers, we do have the volume numbers. This shows you in pesos the total revenues of the 5 developers. And the ones in color, blue, green, and red, are those revenues coming from REITable assets. Owned hotels, owned malls, owned office spaces. And you know what's interesting is that the portfolio of the office sector here is only 9%. It looks very small, but it looks small relative to the total portfolio of these 5 developers. But the next slide shows you how deceiving this slide is. What many people forget is that the Philippines is one of the largest office markets in the world. We have 14 to 15 million square meters of existing office space, 5 times the size of Singapore, 6 times the size of Hong Kong. Yes, the values in the Philippines are 1/10 to 1/14 compared to Singapore and Hong Kong, but we have the volume. Okay? And the beauty about these 15 million square meters is that 20 companies, 20 families own 60% of all this stock. And what does that mean? It means that unlike in many markets where the stock is fragmented and therefore difficult to consolidate, difficult to list at a scalable level, we don't have that problem in the Philippines. We only need to talk to 20 groups to scale up as much as 8 to 9 million square meters of office space alone. Next slide shows you the amount of mall space owned by just 5 families, 5 companies, totaling another 15 million square meters. If you combine just these two sectors, the hotel sector and the office sector, you've got as much as 30 million square meters of REITable assets with very diverse geographies, diverse footprint, diverse tenant mix, and diverse expiry dates, all producing very steady cash flow for long term, which is unique. And guess what? 30 million square meters in the hands of 15 families. Okay, just think about how easy it is to deploy REITs at a scalable level. And this doesn't include the hotel sector. It doesn't include the infrastructure sector, the highway sectors, the hospital sectors, and many other utility sectors as another example. Many other sectors that can be REITed but are not yet in the realm of imagination. So please be excited. There's a lot of bad news out there, but let us not forget the fundamental reasons why we are here today investing in the Philippine market. If we all swallowed and ingested and happy with all the bad news, then we shouldn't have been investing in the stock market, right? But as you know, from March to today, the market is up 70, 80%. Because a lot of people like you and me know that despite all the bad news, there are many fundamental things that are going on right in the Philippines that nobody hardly is ever talking about. And that's why our portfolio is up significantly today. And with that, thank you very much for your time and attention.
Thank you, David, for giving us a glimpse of the potential upside of REITs in the Philippines. After listening to our speakers, let us now watch a short video presentation to help us know more about the regulatory requirements and benefits of REIT listing.
Now more than ever, companies need to rethink ways to access capital and unlock more value from existing assets to spur recovery and post-pandemic growth plans. Now is the time to accelerate growth through REIT listing. A real estate investment trust is a stock corporation created for the purpose of owning income-generating real estate, such as office buildings, residential condominiums, shopping centers, hotels, warehouses, hospitals, airports, and tollways. The PSE amended listing rules on REITs are in accordance with the requirements under the REIT Act and its revised IRR. The general listing rules of the exchange likewise apply. Required dividend policy of distributing annually at least 90% of its distributable income as dividends to its shareholders. At least 75% of its deposited property invested in or consist of income-generating real estate. Must be a public company upon and after listing. Required minimum public offer or MPO is 1/3 of outstanding capital stock owned by at least 1,000 shareholders, each owning at least 50 shares. Minimum paid-up capital of 300 million pesos. Mandatory compliance with the reportorial and disclosure requirements prescribed by the Revised Corporation Code, the Securities Regulations Code, the PSE Listing and Disclosure Rules, and the REIT Act of 2009 and its IRR. REIT listings are essential to the development of the Philippine capital market and have numerous benefits to its stakeholders.
As for Philippine REITs, developers and market players should really take a long-term perspective on this. A REIT should not be viewed merely as a vehicle to liquidate assets or exploit tax advantages. REITs are designed to promote and spur development, broaden investments for the public, and regenerate capital for our economy. the real test of a successful REIT goes way beyond an IPO.
We've waited 11 years for the REITs, and finally it's here. And we in the Philippine Stock Exchange are open for business, and we look forward to working with you as issuers and with other participants to make this dream a reality, and hopefully for the capital markets and the national economy to benefit from this new asset class offered by the Philippine Stock Exchange.
If you want to know more about REIT listing, or you are now ready to start your REIT application, you may book your consultation with us by sending an email to marketingservices@pse.com.ph.
The video that we just showed to you is just a quick recap of the REIT listing requirements presented during the first webinar. Should you wish to view the entire presentation, we will be uploading the video soon in PSE's official YouTube channel. We hope that we were able to provide you with better clarity on REIT listing, and that we can continuously encourage you to consider this asset class as a potential funding vehicle in your post-pandemic strategy. In line with the advocacy of the exchange in helping your company in accelerating your growth plans, we are extending our invitation to you to know more and subscribe in the PSE IPO Listing Assistance Program, which also extends to REIT listing applications. This program aims to provide easier and guided access to potential listing applicants on the process and criteria of the listing application through free hand-holding guidance to clients via one-on-one advisory sessions to potential clients on the process and criteria of listing. Free access to pre-application assessment tools to better evaluate on the listing application readiness of the applicants. Free assistance in connecting potential clients who experience financial advisors to ensure a well-guided listing application journey. You may email marketingservices@pse.com.ph to know how you can take advantage of this program to jumpstart your REIT listing application. During the presentations, we receive a lot of questions which we hope can be answered by our distinguished panelists in a roundtable discussion. Now, I would like to request our panelists to please open your cameras. Joining us again from JP Morgan is Alphonse Halim, Managing Director. Also from Leechiu, may we call on again Mr. David Leechiu, CEO. From the Philippine Stock Exchange, Attorney Ruel Refran, our COO. And now let's discuss the first question addressed to JP Morgan. Mr. Halim, this question is for you. While public market valuations have stabilized to pre-COVID levels, what is your view on corporates pursuing potential REIT listings? Are market conditions conducive?
A very relevant question. Certainly, market is, from what we can see, as David said, in the Singapore market, being, I would say, a barometer of demand for REIT asset class here, is open. Equity and debt market for whether it's IPOs or follow-on offerings. So I think that's certainly wide open. But it does differentiate. Investors do differentiate between certain asset classes versus the others. So I think what we've seen so far is a lot of demand for industrial asset class in terms of equity flows and selectively through retail, and retail being a big beneficiary of sort of the unwinding trade, if you will, the rotation, as they call it, given the vaccine. So certainly we've seen that happen in Singapore. As it relates to the Philippines, I think by and large, the strategy of creating a REIT certainly makes sense. And it's obviously down to what investors are willing to pay in terms of what the yield is and how does that yield compare to issuers or corporates, developers in this case, cost of capital. So I think that discussion will have to find itself some ground next year as asset performance recover, and we have more visibility into rents, etc. But as a question of does this strategy make sense, I think it doesn't detract nor does it take away the story of the REITization, if you will, of the Philippines property market. Varying sector to sector, so we'll have to see what 21 bears in terms of rental performance across the major asset classes.
Thank you, Alphonse, for sharing your perspective. It's very timely as we expect more REIT applications, hopefully next year. And then another hot question. Apart from the webinar, we've been receiving this type of question, and I'd like to seek for the expertise of Mr. David. What types of REITable assets do you think will be high potential in the Philippines?
I think the transportation infrastructure REITs will be big because as the per capita income rises, more and more people will buy cars or have access to cars, and it'll just increase the need for more tollways and bridges. And as you know, we haven't built. We are like maybe 30 years behind in the infrastructure program, and this is not just in country. I mean, in Metro Manila or Mega Manila, this is all throughout the country. You just look at Cebu. Cebu is just building their third bridge, their first rail. When was the last time they built a highway? And yet the traffic there from airport to the heart of Cebu takes you an hour, where it used to just take 20 minutes. And so I think the infrastructure REITs would be very exciting. These are very long-term projects. They will find more efficient ways to raise capital through this avenue. The second one would be the hotel REITs because, in many parts of Southeast Asia, the hotel REITs are a fantastic place, and this will allow investors in the hotel sector to get more of their capital back, because the old way of doing it is just too slow, too inefficient. The margins in the hotel sector are too low, and I think that's going to change. If you can only imagine that if we even go up to 50% of what Thailand is doing in terms of tourism traffic, which is 40 million in Thailand versus 8 million, and if we just try to aspire for 20 million, that's a 2.5x of where we are today. How much more road networks, how much traffic is going to go through our airports, how much is all that going to cost in terms of funding for bigger and better and more airports, more seaports, more connectivities? So I think in summary, hotel REITs and infrastructure REITs would be very, very big.
Thanks, David, for those answers. Certainly, it will help our fellow applicants, possible applicants, as they plan for their post-COVID recoveries for 2021. The next question, Sir Ruel. Sir, this question is very timely, especially during now the time of pandemic. Can IPO proceeds of a REIT be used for debt servicing? For the sponsors, promoters, will this be compliant with the domestic reinvestment requirement?
Thank you for the question. If you're referring to the use of proceeds in an initial public offering, the determination of the appropriate use of proceeds will be up to the judgment of the issuer. That being said, use of proceeds being devoted for, let's say, part of the proceeds will be to repay or refinance debt, that would be within the parameters of the allowable uses of proceeds for the issuer in an IPO setting. On the second part of your question, if you are to deploy, and you're referring to the sponsors, if you are to deploy the cash or the funds that were generated by way of the secondary offering in an IPO, you are actually required to comply with the domestic reinvestment requirement, which is indispensable under the rules of the PSE as well as of the SEC. If you are to use that to repay debt, the prevailing standard will always be you have to connect that to either a financing or the development of an infrastructure project or real estate project. To the extent that you could make that connection with respect to financing or developing a real estate or infrastructure project, then by the provisions of the implementing rules and regulations, that should constitute an allowable domestic reinvestment for purposes of the 1-year reinvestment requirement under the REIT IRR. So again, in summary, for IPO, for use of proceeds, yes, that debt repayment is allowed. For the sponsors who are required to conduct to comply with the reinvestment requirement by reason of the cash that they receive in the secondary offering of an IPO, as long as you could connect the payment of the debt to financing a real estate or infrastructure project, then that would be compliant with the domestic reinvestment requirement.
Sir, thank you for that clarification on that matter. But another follow-up question just came in from the audience. Still for you, Attorney Roel. Sir, can a lease be considered an income-generating real property that may be transferred to a REIT? Is this restricted by the REIT regulations?
Very good question. In fact, we have seen I would say, an iteration of this structure in the A-REIT offering. So just for context, number one, 75% of the deposited property has to be by way of an income-producing real estate. Now, the question is a lease contract or entitlements to the lease rentals, would that constitute as compliance for purposes of income-producing real estate as required under the implementing rules and regulations? If you read closely the implementing rules and regulations, as well as the REIT Act itself, which we had the privilege of being a part of, the definition of real estate, we actually connected that with Article 415 of the Civil Code. And essentially, 415 of the Civil Code provides that real estate is interchangeable with the term immovable property or real property. A property could be immovable by nature, in the case of a land. It could be immovable by destination or by incorporation, by law, simply because there are appurtenances or structures attached to a real estate which will be destroyed if you remove it altogether. Now, there's another provision in the Civil Code which allows for real rights over immovable property as falling within the definition of an immovable property or real estate. And so in the implementing rules and regulations, if you connect this definition, there is a provision with respect to leasehold rights, which would have to be registered with the Registry of Property for it to constitute as an income-producing real estate, right? So again, if it's an ordinary lease which has not been registered, then it would not be compliant. However, if it constitutes a lease which has been annotated with the Registry of Deeds by way of it now being a notice to the whole world that there is now an entitlement by which the lease payments will now flow into the REIT vehicle, then I would say that constitutes compliance with the requirement to own income-producing real estate. Again, the preference would always be direct ownership, right? If the newly constituted REIT happens to have underlying real estate, well and good. However, there might be instances where the income that's derived from another asset, which is not yet in the name of the REIT, for as long as that lease or that real right has been registered for it to actually constitute as notice to the whole world, then that would have basis for the argument that could be income-producing real estate.
Thank you, sir, for shedding light on that particular topic. For the next question, I would like to address it to Mr. Alphonse. Alphonse, the question is there a type of asset out there that can be very REITable, but not yet listed as a REIT in any market? A unique asset type which a company should be considering to list as a REIT?
That's a hard question to answer. I think a simple answer to the hard question would be, in my experience, and it spans the US market as well, obviously the most developed. I've seen in my career pretty much all major asset classes being REITed. So some of those are not have not materialized in the Asian market. So, for instance, we have or they had the US self-storage REITs. Some of them are the largest REITs in the market. They have even if you think about it, fuel station or gasoline station REITs by the likes of Getty at some point, Getty Realty. So pretty much any, as Attorney Rel said, immovable real estate that can produce a predictable set of cash flows, whether through contracts, long-term contracts, or some sort of a construct that allows a predictable, as I said, rent roll can be in a way REITed. So I think I haven't seen certainly any new asset class. I think the types of assets that we're seeing coming to market also in what I call earlier the new economy are the asset classes that are in a way hybrid between asset owning and entities as well as operating businesses. So we have not seen a data center REIT yet in the Philippines. I've no doubt in my mind there will be one in the future, but there is a couple in Asia. So I did mention Keppel Data Center REIT. That is effectively a real estate. Data centers are brick and mortar real estate, but also a significant amount of value comes from the, if you will, as they call it, the M&E. So these are the operating aspect of real estate. So we are seeing the market as it mature over time to include other adjacent asset classes. There may not be 100% direct real estate. So I think that's the, and in terms of the possibility, I mean, the REIT asset class continues to evolve and grow, and we see, as David Leechiu said earlier, potential for expansion into the infrastructure asset class as well. So in a way, warehousing is quasi-infrastructure. And we've seen toll roads in markets like, say, Thailand being, packaged into a trust product. And we've been, lucky in making that happen as well. So I think that's it's a very flexible asset class. Ultimately, the question is, as in the REIT investors, what they are in it for is really a total return. They want a predictable, stable set of cash flows and growth. And it's not meant to be a product that generates super normal growth. I mean, it's really, in some regards, boring is good. So to the extent that any asset class that can generate predictable cash flow, I think that's a very good candidate for being a REIT.
Thank you, Alphonse. I'm very sure that the audience will appreciate that, especially that there are a lot of potential applicants as participants for today's session. The next, I would like again to address to Mr. Leechiu. Sir, how can the REIT be considered more inclusive and attractive to all kinds of developers in the Philippines?
I think there will be two markets that will emerge from this REIT sector. The first one are the ones who will sponsor the REIT. And then the second market will be the ones that will feed the sponsor with assets. For example, there's so many developers out there, but they only have 2 or 3 buildings, and they're small buildings. But then you've got, let's say, a company like Ayala. And Ayala says, I want to grow my portfolio, as an example, okay? So they will just go and talk to developer and say, okay, why don't we enroll your asset portfolio into our REIT, and we'll give you a share to asset swap of some sort, and do a new listing of shares, and many other types of situations like that. So I think, again, there will be the sponsors who have their own assets, but then there will be companies that will emerge from this that will build portfolios to sell to a REIT or to a REIT sponsor to be able to achieve a scale that is worth doing. For example, I think the first couple of REITs will be trial balloons because we're still learning the ropes of how the market will respond. But there will come a time very soon, I think, where the developers will enroll and enlist mega assets so that they start listing at $1 billion, $1 billion and larger transactions.
I hope that provided fruitful insights, especially for the developers in this seminar. The last question, again, I would like to address to Attorney Roel. Roel, can a REIT decide to fully retain its earnings and not to declare dividends for more than a year for purposes of corporate expansion?
Very good question. This was passed upon in the deliberations, the Senate and in Congress way back in 2008, 2009. I'll anchor the answer on the tax incentive, among which is the additional dividend deduction by way of taxable net income. Ordinarily, that is not an avenue by which a corporate entity could actually lower the tax base. But in a REIT structure, you could actually lower your taxable net income by way of an allowed additional deduction, and that is the dividends that you have declared and distributed, the requirement being 90% of distributable income. So I highlight the term distributable income. Distributable income would then exclude any appropriations occasioned by, let's say, a future project requiring cash to be for development purposes or to complete a project. Now, if you do not distribute because of appropriations required or for strategic projects, then the fact is that you cannot actually invoke the provision by which you could actually lower your tax base. So your 30% corporate tax will be applied as in an ordinary corporation without the benefit of dividends because you did not declare dividends. Now, I just like to highlight again that REITs are required to at least declare 90% of distributable income simply because investors are looking at this as a yields instrument. Therefore, for you to continue to be listed, you have to comply with that requirement, subject to exceptional cases where under accounting rules, under corporate rules, as well as the REIT framework, you could actually devote parts of your resources for purposes of development in the future. But again, this has to be disclosed and this has to be readily monitored, because the moment those projects are completed, then you need to adjust your distributable income, simply because then that would be part of the allowable distributable assets. Okay, so again, this is anchored on the requirement that for you to declare dividends, there has to be retained earnings, right? It's an elementary requirement. Therefore, if there are appropriations to retained earnings, then you could say that the corporation is unable to declare dividends. And that being said, the compliance, nevertheless, with the 90% dividend requirement is still the centerpiece of REITs, because investors invest in REITs in expectations of returns by way of the cash dividends or even the property dividend that may be declared and distributed by the REIT.
Thank you, Sir Ruel. Another important question just came in, and I'd like to address this to both Alphonse and Mr. David Leechiu. Maybe we can go with Alphonse first, and then next is Sir David. The question is, the market clearly rewards larger scale REITs from a valuation perspective. Does this have implications on the seed portfolio sizes of potential REITs?
Thanks for that question. I'll take that first. I think the short answer is absolutely. The scale, to a certain extent, do benefit from a valuation perspective, specifically from a yield perspective. So larger REITs, all else being equal, should trade at a tighter yield. And why is that? Because one, there's the general technical aspects, meaning free float liquidity, and volumes traded, etc. The more liquid a REIT is, and this rule applies with generally securities in general, there is a tighter cost of capital associated with it. And we see this in the Singapore market, to borrow that market as an example again, very clearly. So there's a number of REITs in the same sector, more or less of the same quality, but we see a bifurcation. As in the case for Singapore, the number happens to be around 2 billion Singapore dollars market capitalization, where the players that are sub 2 billion trades at a real difference in terms of the yield that is higher than those REITs that are above 2 billion. Part of this is indexation impact. So in Singapore, about 15 REITs are indexed to the NAREIT index that are one of the more followed by the ETFs investing in this space. So there is a certain amount of passive money, if you will, because of the benefit of indexation will automatically be invested in those REITs. So that benefits from a demand perspective, and obviously consequentially has an effect on making that yield tighter. So I think, if you work backwards, then if you're solving for a certain, if you will, a sweet spot or optimal IPO size, then it impacts the amount of assets that should be seeded in a REIT. Now, what I would say for the Philippines, though, is it is a nascent market by consideration. I think investors will like to have a larger issuance from a technical perspective, but more importantly is the quality of the sponsors, the assets. So I think that's in a new market, investors tend to gravitate towards the more seasoned and the developers and sponsors that have more track record. I think more important than sheer scale per se. I think scale over time will be a differentiating factor as the market continues to grow, but not the first criteria, if you will, for a nascent market such as the Philippines.
Thank you, Alphonse. David, would you like to add?
I would defer to the expertise of Alphonse. I would say that, yeah, I think liquidity is very important, and you can only do that with scale. And it's a chicken or egg, situation. If you don't have the scale, you won't get the buyers, and if you don't get the buyers, you won't get the valuations. So yeah, so I think more than anything, at least from what I've seen and learned, size does matter.
Thank you, David. Thank you to our panelists for answering our questions or sharing your thoughts. Indeed, this has been a valuable learning experience. To those who still have questions and were not taken up during the session, you may email us at marketingservices@pse.com.ph. And now, for the closing remarks, may call on Attorney Roel Refran.
Thank you, Pao. And I really am very, very happy that we have an opportunity to engage the real estate sector as well as those who are contemplating a REIT public offering. Thank you very much to JP Morgan's Alphonse Halim as well as to David Leechiu for sharing with us your valuable insights. And I think I am almost always reminded that whenever we launch new products, there's always that element of risk, but more importantly, there's always the element of opportunities. And I think we in the Philippine Stock Exchange are always animated and driven to ensure that a product is never static. There will always be room for improvement. There will always be innovation. As shared with us by the speakers, the terrain, if you look at REITs in Singapore, in the US, and in other advanced markets, has evolved as well through the past decades. And so in the Philippines, while we are just starting, and mind you, it's been an 11-year wait, we are always eager to learn and to adopt the conventions and the best practices as they are probably a better model. We have discussed the nuances of REITs, but altogether, really a REIT is a corporation that would have the promise for yields by way of the income generation by its underlying real estate, whether direct or indirect. And I think the success of this new public product, this new asset class, I would say, for the Philippine capital market, hopefully would be a confluence of events, especially as we see the big names participating in REITs, as well as probably eventually over time having a REIT index so that the passive investors would also be able to participate in this very exciting asset class. And at the end of the day, we in the Philippine Stock Exchange, mindful of our role as a self-regulatory organization, would always like to interface with our regulators, the SEC, but also with the participants, the underwriters, the issuers, and the investors, simply because there will always be a new learning for us. There will always be a better framework. And that being said, REITs can be a success story for the Philippines. And finally, I think we owe it to the SEC, we owe it to the regulators and Congress for allowing us to have a chance at REITs. I say this because back in 2009, I remember when we submitted the bicameral conference committee report generated by both the House and the Senate to Malacanang. It was a very, very stressful situation because, of course, there would be revenue loss by reason of the tax incentives, tax benefits. But as fate would have it, REITs was bound to be born. It was bound to happen. What happened was it was actually a case of the bicameral report not being signed, but being a law because it lapsed into law. And very rare in my legal practice have I seen this, but REIT was to be a centerpiece of this of the capital market development and occasioned by the legislation, of course, by the regulations, including the Bureau of Internal Revenue, the SEC, and the PSE. So I would say this is the prime environment for us, and for us to make this a success really would require us to work closely, and our marketing services department is at the center of this initiative. We have what's called the Listing Assistance Program. We really encourage you to touch base with our marketing services department with respect to REIT, and even for your other IPO needs. We are there to help you, and hopefully to make the experience a less stressful and a more, I would say, a more calculated approach, so that we could actually allow you to fundraise through the Philippine Stock Exchange. Again, thanks to our speakers, and thank you for everyone for spending their valuable time with us this afternoon.
Thank you again, Sir Ruel. Thank you again to all participants for taking time to attend PSE's REIT Smart webinar series. We hope that you were able to gain valuable insights and strategies from the REIT listing learning sessions that we prepared. This is to extend our thanks and appreciation to all our guest speakers and panelists in sharing their learnings and on-hand experiences on REIT listing. For any additional inquiries, or if you are now ready to start your REIT application journey, you may book your consultation with us by again sending an email to marketingservices@pse.com.ph. Again, from the Philippine Stock Exchange, Inc., thank you and enjoy the rest of your afternoon.